think that the masses have gathered. Uh, Peter, may I please invite you to do your talk?
Okay. Well, it's a pleasure for me to be with you, be it only virtually. Yesha asked me if I could say a few words for this forum, and as I was logging in on the previous talk, I thought this was all very real, a very real subject matter. I'll be speaking about something much more virtual, namely decentralized finance or decentralization, and whether or not we are moving towards a bold new world of decentralized finance. It's been 14 years since Satoshi Nakamoto presented his or her or their Bitcoin white paper for a peer-to-peer electronic cash system. And this paper, although a bit technical, really set forward a payment system or a value transfer system that allowed a transfer of value without relying on an intermediary or a trusted third party or service provider. So it was a system where a database of positions was going to be managed decentrally and updated by a decentralized system of nodes and miners. And while initially this blockchain, and probably still to a large extent, was the province of nerds and computer whizzes and libertarians, sometimes they're the same people, sometimes they're different. Bitcoin was very much the launch of a movement towards blockchain-based finance that relied on mathematical and cryptographic truth rather than trust. So typically in financial services and in services generally, or in the economy at large, people operate on the basis of trust. Trust in the law, trust in their counterparties, trust in a financial regulator, trust in a central bank. And the blockchain system would do away with all of this need to trust others, because the ledger itself, shared among many people, was the truth. And where there is truth, there is no need for trust. That at least was the premise of the blockchain movement. And this would create a world of economic freedom, we hear, and it would lead to financial inclusion for all those that are currently excluded, either by their own choice or because the traditional financial system does not cater for them. And therefore, this blockchain development would be of major importance to economies around the world, and in particular to the emerging economies. So, taking it even a bit further, this blockchain would become the holy grail of a decentralized Web3 future, where intermediaries disappear and where everything is replaced by code and smart contracts. This idea was very much to the horror of the established players, be they market participants, established market participants, or established regulators. And I think the people who were most horrified by all of it were the central bankers of this world. And really, central bankers around the world, it's very hard to find central bankers that have anything positive to say about blockchains and crypto assets. Now, having seen a number of boom and bust cycles in this crypto ecosystem, and I personally count at least three. We saw a boom in 2013, another boom in 2017, and then finally one in 2021. So three big bull runs, followed by an equal number of bear markets, or what they call in crypto space or in blockchain space a crypto winter. some even say crypto ice age. The question in front of us, if we see, well, there is this movement towards of blockchain and of economic freedom, and we see that in bull runs, there's an enormous amount of value amalgamated in the system. Is there really a future for crypto assets and distributed ledger-based finance? Or is this decentralized finance really a pipe dream and at most an interesting math and cryptographic experiment, but not really suitable for serious business? Now, to answer this question as to whether this future exists or is possible, we have to reflect a little bit on the nature of financial services. And if you think a bit about it, financial services are an exercise in centralization, or better put, in centralized account keeping. It doesn't really matter whether you're looking at payments or lending, credit, investment services, fund management, trading, or insurance. In all of these financial fields, what you're dealing with is an intermediary or a centralized party that holds and manages a centralized ledger. And this ledger presents his or her version of the truth. It says who owes what to whom, or who owes what. That's basically finance in a nutshell. And the business of providing financial services amounts, inter alia, to updating this ledger. This is or these ledgers held by all of these financial institutions. This is a system that works reasonably well, but it's also quite inefficient, and a lot of time and effort is spent on reconciling the accounts and the ledgers of different institutions to make sure that their notes compare. But in this world of traditional financial services, the user, the customer, the counterparty really trusts the service provider or the ledger that service provider holds. And the ability to trust this service provider is very much assisted by legislation and regulation. General legislation governing contracts and liability, but also specific legislation in the financial sector governing the prudential supervision and the market conduct of financial operators. And this regulation is very, very important for trust. And I think this has been ably demonstrated in the 2007-2008 financial crisis and the subsequent years, where if we look back at the causes of that financial crisis, and they were diverse and they have been studied at length by policymakers and regulators and academia around the world, but I think there was a strong consensus that one of the root causes of the financial crisis was insufficient regulation and deregulation enacted in the 1990s and the first years of the 20th century. And this lack of regulation allowed for undue risk-taking, financial alchemy, hubris, that really undid the traditional financial system and that undermined the trust that is so essential to centralized account keeping and centralized financial services. So we can say that the crisis in the financial sector was a crisis of trust, and this crisis of trust was in significant part due to inadequate regulation. And it was also against this background that Satoshi Nakamoto put forward his white paper, his blockchain or his Bitcoin white paper, to develop a peer-to-peer trustless system, a system where you don't need to trust anyone because the code was truth, and truth is superior to trust. Austrian school adepts, libertarians, love this. They said, oh, we can finally do away with fractional reserve banking and the double spending problem, which are the devil's work. We're going to move to a world of decentralized ledger keeping, and everything will be better. Now, if you look at that, if you look at it from that perspective, so on the one hand, we have the traditional financial system, a system of centralization, of central accounting, and now we have blockchain of decentralization, of decentralized account keeping, and in a way, this decentralization is the very antithesis, the very opposite of what financial services are about. And so the question is the thesis going to be done by an antithesis, or will we end up with some kind of synthesis in the end? Now, before I get into that specific question, I would like to say a few words about the nature of regulation and how this could be governed. And I'd like to talk a little bit about functionalism and formalism in financial regulation. The predominant view among traditionalists and financial regulators is that blockchain-based finance or decentralized finance, if it works at all, is still finance. And financial activities are reserved for entities that are duly regulated in the different jurisdictions. From a prudential point of view, from a market conduct point of view. And often these regulations require, they reserve the activity for specifically regulated entities that have to be duly incorporated and established and subject themselves to the supervision and the regulation of a financial regulator. And these regulators say, well, we take a substance over form perspective, and it doesn't really matter how you're organized or what technology you use. We look at the function you perform, and if you perform a financial function, you're a financial services provider, and the regulation applies to you. And from a policy point of view, and I'm a policymaker, this is a very valid position, or at least it appears to be a very valid position, that if you carry out a particular activity of a financial nature, you're providing financial services, and therefore you should be regulated as a financial services provider. But if you scratch a bit at the surface of regulation and policy, you'll see that most regulators and legislators around the world are not as functional in their approach as they pretend to be or that they hope to be. In many, if not most countries of the world, and certainly among the G20 nations, we see that there's a strong tendency to also go for what I would call definitional approaches and divisionalism, or maybe formalism, better, formalism in regulation, formalism as opposed to functionalism. And in formalism, the formalists, they value definitions. Lawyers value definitions typically, and they parse reality into all kinds of categories. And if you fulfill, or if an activity fulfills the constitutive elements of the definition, then they're captured by it, and the requirements of financial regulation apply to them. By contrast, if for one or the other reason you do not meet one of the constitutive elements of the definition, you fall outside of the scope of the definition, and therefore the rules do not apply to you, even though from a more functional point of view, you're actually engaged in the same kind of function. So, for example, to provide financial services, you need to be to provide payment services, you need to be a payments institution. That means that you need to be established, could be a formalistic, a form requirement. But if you're not established, if you're not an entity, that doesn't mean that you can't actually perform the same function. So you see that there's a tension between functionalism and formalism in financial regulation. And some people say that, well, those policymakers and regulators that take a principles-based approach to regulation are functionalists, and those that take a rules-based approach to regulation are formalists. I think there's something to be said about that argument, although it is not really 100% match. If you analyze that through, you'll see that functionalism is not the same as principles-based, and formalism is not the same as rules-based, but there is definitely correlation between the two. Now, the legal system I know best, that of the European Union, very much has signs of both functionalism and formalism in its approach. And this leads, and we often oscillate between the two, but this tension between the two, the fact that we combine both functionalism and formalism in our regulation, also leads to a great deal of confusion and to legal legal uncertainty. We see this in the European Union, but we also see this, for example, in the US, where regulators are grappling with decentralized finance or crypto assets in particular. And while they tend to bang on about the rule of law and how important regulation is, they often come up short in their traditional definitional or formalistic approaches about regulation, and even Supreme Court jurisprudence, for example, in the US, seems to pursue a formalistic approach in defining what are securities or what are investment contracts. And when the formalistic approach falls short in actually in capturing a particular reality, the regulators just shift the approach and say, well, we pursue a substance over form approach. It doesn't really matter whether you meet all the formalistic elements of the definition, because we are functionalists and we just look at the nature of the activity and whether you are providing a financial activity. And so their view is that, we also see it in the EU, but we also see it in Asia, that all of these crypto brothers and crypto sisters, even if they do not meet all of the definitional formalistic elements, they should just comply with the rules and behave like everyone else. Now, I'll leave this distinction between functionalism and formalism for now, but I think it's very important when you look at decentralized finance, because decentralized finance often has elements which are missing, foundational elements, definitional elements that are missing, and therefore it's often very hard to apply formalistic rules to it. Now, before I'll conclude on my statement as to whether we're going to a bold world of decentralization, I'd like to highlight the fact that although there's an awful lot of talk about decentralized finance these days, most decentralized finance isn't really that decentralized. Now, it does use decentralizing technology, so there's a lot of use of blockchains and cloud computing and other decentralizing technologies. And Bitcoin as such was indeed this peer-to-peer cash system. So the Bitcoin blockchain definitely is a decentralized ledger, and it's updated in a decentralized way. But if we look into the blockchain economy and the decentralized ledger ecosystem, and we look at blockchains like Bitcoin or Ethereum or Cardano or Solana, and there are many more, what we see is that they have given rise to, yes, the emergence and the updating of that blockchain in a decentralized way, but at the same time, they've given rise to an entirely new set of centralized intermediaries. Decentralized intermediaries love to tout on about economic freedom and financial inclusion and gateways to wealth, but they are centralized players who are intermediating services, blockchain-based services, to users. They do not specialize in updating these ledgers or in managing the decentralized ledger, but what they're doing is they're providing brokerage services, exchange services, custody services, fund management services, market making, payment services. Basically, all the services which we see in traditional finance are being replicated in the decentralized world by entities that look very much and behave very much in the way traditional financial entities operate. Most crypto asset exchanges, for example, do not run what we call an on-chain trading venue. Their order book and their matching engine is really off-chain. So they run an exchange like any other exchange, where people just trade IOUs for crypto assets rather than engage in transactions on the blockchains. So most decentralized finance, or people in the decentralized finance space, are actually centralized entities. But that doesn't mean that decentralized finance doesn't exist. It does, much to my own surprise. I was surprised that it is actually possible to borrow money from code, or that it's possible to be insured by a smart contract where there is no counterparty, no entity on the other side that takes the risk or that underwrites the risk. It's the code that underwrites the risk. And of course, many people put collateral into the code that is actually used to generate the protection or the revenues to pay you out in case the contract goes in your favor or you incur a damage that leads to a payout. Now, while so decentralized finance does exist, most of the blockchain finance is actually intermediate finance, which is not that different from traditional financial services, and where a at least functional approach to regulation should be able to get you a long way in regulating these entities if you believe they should be regulated. But if you look at the really decentralized approach, where there are no intermediaries, where you're dealing with non-entities, non-persons, there isn't really anyone to regulate. Because if you look at regulation and legislation the world over, financial regulation specifically, it is always administered through the intermediaries. We regulate the intermediaries that engage in an activity that is reserved for intermediaries that are regulated in a very particular way. And using either formalism or functionalism isn't going to get you anywhere. There's just code that runs on a decentralized ledger, a smart contract, and while we've thought a great deal about it, we haven't come up yet with an idea on how to usefully regulate this, because we haven't found anyone to regulate.
Peter, sorry to rush you, but could we wrap up in 5 minutes and then we can take questions for 5?
Yeah.
Thank you.
We'll do that. So I'm just going to my point. So now, are we going to get somewhere on this? I believe that neither functionalism nor formalism is going to get us anywhere in decentralized finance. And assuming that decentralized finance needs regulation to create trust or to make it accessible to legal entities and the established financial system as well. And maybe what we'll need is something like what I call a Palmerstonian revolution in honor of former Prime Minister Palmerston in the United Kingdom, who is seen as responsible for the introduction of what was in the mid-19th century an entirely new concept in law, the limited liability company. Before that, no one ever thought about the limited liability company, and it became very much the cornerstone of modern economy and how companies are organized. And maybe, I don't know, but maybe for decentralized finance, this is what we need. Especially as we've seen a number of major failures in the crypto space in 2022. We've seen, of course, most recently FTX going under, but we've also seen others like Voyager, Three Arrows Capital. Just thinking about the other ones which went under, there were 5 or 6, BlockFi, Celsius. So a number of them failed, all of them actually not being decentralized players, but all being centralized players that were exploiting the weaknesses of formalist regulatory tendencies. And so while their activities from a functional point of view were exactly the same as what financial services firms typically provide, they were able to escape the regulation by setting up in what I would call palm tree infested islands, but also by exploiting the gaps that are caused by formalism. Now, so we need I think, for decentralized finance to develop, we will need to bring it into a legal and regulatory framework, and that will require a new paradigm on how we address regulation. But also, apart from the legal and the regulatory point of view, I also think that decentralized finance, if it is to become successful and mainstream, it will also need to develop some real-world scalable use cases. So I said we do see insurance, we do see payments, we do see lending, but not really at a very, very large scale. So hopefully that will develop and that will be necessary for decentralized finance to emerge. A second thing which will be absolutely necessary for decentralized finance to take off is that it will have to develop a much more acceptable and usable user interface. The user interface for decentralized finance currently is very, very complex and quite off-putting. And you have to be extremely motivated or very libertarian and very anti-centralized institutions before you before you will engage with this software in a decentralized way. And that's why most people actually go for the convenient option and access decentralized finance through centralized intermediaries, turning it into, of course, just another version of centralized finance. So pending the development of these use cases and the development of a better interface and the development of a new paradigm for regulation and policy, I believe that decentralized finance and decentralization are very much something of the future, something which we may be moving towards, but whether we'll actually ever reach it, I do not know. So I do not think that we are going to see the bold new world of decentralization anytime soon, but I may be wrong. Thank you.
Thanks, Peter. We can take questions. Yes, please.
So from what I understand, one of the basic things for finance as a industry to function is credit. And we spoke about lending. But any lending in the DeFi space currently is over collateralized, right? Which is that if you want to borrow 100, you need to deposit 300 of Bitcoin or something, and you'll get 100 stable coins. So, any thoughts on how this could take off? Because if every lending function, which I believe, and which leads to credit, which leads to the entire finance industry taking off, the current paradigm seems to be over collateralization, because there's really no way, if you don't have the money, that code can extract it out of somewhere. So, any thoughts on how you see that evolving? Because there's one of the things that I've struggled with for a really long time as to how margin lending, or which is, where I need to put collateral of only, say, 20 and I get a loan of 100, how that could take off in DeFi.
No, that's a very good question. And it speaks also very much against this idea that this decentralized finance or decentralized lending is a source of financial inclusion, because you need to have assets, and quite a lot of them, before you're able to actually borrow something. So if you don't have anything, you're not going to be able to get any credit in the decentralized space, because the code is not going to run a risk on you, and it can't make an assessment of you. So you have to post indeed collateral, you have to over collateralize. And this collateral often is very volatile. That's why you need to over collateralize. So if you, for example, you can borrow cash against stable coins, but that's fairly pointless, because why would you put, say, for example, US dollar or US dollar tether, US dollar coins or US dollar tether as collateral to borrow US dollar? That sort of is a pointless exercise. What we do see is people who have Bitcoins or Ethereum or whatever, and who are banking on it becoming valuable again or more valuable again, and therefore want to hold on to it. So they don't want to sell it, but they nevertheless want to borrow against their holdings. And so that's what you see. So you can see, rather than fractional reserve banking, I would almost call it fractional reserve borrowing. So if you have indeed a large pot of Bitcoin, you can borrow half the value or a third of the value in another stable coin. And the system typically works that if the collateral drops in value, it automatically gets liquidated. But so it's a system that is hard to scale. It happens, but I don't really think it is a way to operate large-scale lending or credit facilitation. Thank you.
I have a question. Yeah, can I? Good. Hi, Peter. Thank you so much. I think it was very interesting. Basically, OECD has come out with the CAF reporting standards. And when you go through the CAF, you really feel that there should be at least one entity, if not more than one, who should be regulated. So what is your view on this CAF reporting? And basis that, would you be having some regulations coming out for one of those entities?
Well, it's in the common view, not only of the OECD, but in many jurisdictions, that you need to have an entity, and that entity should be regulated, or that if a group of people or an individual wants to perform a particular activity, they need to incorporate, they need to set up an entity and subject that entity to regulation. But that is an aspirational wish or requirement. And by promulgating it, indeed, law-abiding individuals may indeed establish, even though it goes against the nature or their original ideas, but they may establish themselves because that's just what is required. But what do you do as a regulator if the people who develop decentralized applications say, look, we're not going to set up an entity. We're not going to subject ourselves to regulation. Who should the enforcement authorities, who should the regulators go against? Because there is no entity to drag in front of court or to drag in front of a judge, because it is a decentralized, it's what they call these decentralized autonomous organizations. It's a gathering of people who devote their spare time or all their awake time to developing this code, and they are not in control. They do not run it. They're not providing the service. They're just updating this decentralized database. So saying you should be regulated or you should set up a regulatory entity, I think is a reflection of very traditional finance and regulation. And it really is, I believe, a recognition of the fact that we do need a new paradigm for organizational or regulatory entities. If the requirement is going to be that decentralized activities and blockchain activities need to incorporate into traditional regulated entities, that is going to inhibit and limit the possibilities of distributed ledgers and blockchain development. But we need to find a way to integrate these movements, these activities into law, and therefore some kind of registration, some kind of entity, if you wish, I think is that can be subjected to the law is, I believe, necessary. But I do also believe that we may need what I call this a Palmerstonian revolution in corporate law, if you wish, for new kinds of categories of entities to emerge so that this activity can be brought under regulation. And with a simple, like, how could you organize a decentralized autonomous organization for the purposes of the law? Thank you.
Yeah, Peter, my question is, if you want to make a true decentralized financial system by integrating a legal process or entity into it, who will absorb the cost of this entity in that system?
Well, that's a very good question. Is that if you set up an entity that invokes costs, but also the question, of course, is there's a bit of a chicken and egg story in here. Is if the world is governed or economy is governed in most places in the world by capitalism, you take the view or you share the view that people want to ring fence part of economic activity for themselves, they want to reserve it for themselves, and they want to exploit rents on that activity. And therefore they establish themselves so that they can protect it. What I haven't seen yet is why would people invest time and skill and effort in developing decentralized code if they don't stand to benefit from this for themselves. Now, you see some of that indeed, and you see, of course, open source activities, but sooner or later, people want to make money of this, they want to be compensated for this, and therefore they want to appropriate part of this development. And typically, how they do that is by setting up an entity and bringing the activity under that entity so that they can exploit it, but they can also protect it against others. So maybe capitalist imperatives do not go well together with truly decentralized finance or decentralized activities, because in a way, decentralization could also be the antithesis to capitalism. This is a bit of a philosophical comment, but I do think there is some truth in that. And if decentralization is the antithesis of capitalism, then maybe decentralization hasn't a serious future ahead of it at all. Thank you.
Thanks, Peter.